Hey guys, welcome back to my channel. So I've got a video that's going to be a very simple guide on when you should sell your Bitcoin. Now, for those that have come to my channel, you're probably going to find that the general theme is that I'm overall against speculation, whether that's meme coins, even just altcoins in general, and especially leverage trading. I'm much more prone to tell people to just buy and hold their Bitcoin even through bear markets, because ultimately it's about playing the long-term game, and I don't want to encourage people to go down a speculative route, which is something that I'm very strongly against, as I've seen many people get wrecked over periods of time simply because they refuse to play the long game and they want to try and make some easy gains. And that's why I want to be very careful with this video in regards to giving you advice about when you should sell your Bitcoin. But at the same time, I recognize that there is a need to know such kinds of information, because although I recommend you should always just be DCAing into Bitcoin, and you should always be holding it as opposed to selling it, there are going to be times that are a little better to buy Bitcoin, and there are other times that are a little better to sell your Bitcoin if you want to sell it at all. Maybe you just want to take a little bit of profit off the table. Yeah, I think that's a completely reasonable thing to do, but I just don't want to recommend anyone go all in or all out, because I don't think that's the smart thing to do. But first, if you like this channel, if you like tips on how to debank, if you like tips on how to do peer-to-peer cryptocurrency trading, maybe because you like trading without KYC, or maybe because you want to make money selling crypto on the P2P markets, make sure to subscribe to my channel and use my referral links in the description down below if you're interested in buying crypto without KYC. So let's get into the video. So I have a very simple formula that this is very fundamental for those that are, I guess, a little more advanced in this stuff. What I'm about to talk about is not so, it's not so like amazing. It's nothing, it's usually things that people know very well if they've been in this stuff for a long time. So basically, anyone that's been in the crypto world for like more than a year is following what you'd call these 4-year halvening cycles. So a 4-year halvening cycle is based on an event known as the Bitcoin halvening, where halving, as I should say, I keep botching that, and basically it's where the reward for the Bitcoin mining goes down in half. So originally, back in the day when Bitcoin was first created, every time Bitcoin was mined, I think it was like every minute, or I can't remember the exact amount, a new Bitcoin would be created, and it would be rewarded to the miner who was able to solve the I think it was the SHA-52 algorithm or something like that. So whoever was the first to be able to solve this algorithm out of the millions of people millions of miners that are out there racing to solve this complex algorithm, whoever was the first to solve it would be the one to be rewarded with a Bitcoin. And these are the people that are helping run the Bitcoin blockchain, right? They were going to be rewarded with a Bitcoin, and then they'll take that Bitcoin to the open market to sell it. And selling it was very important because they had a lot of upkeep. They have energy costs, they've got to pay for hardware, and some of these Bitcoin miners would actually become larger companies that, where they've got employees to take care of, they've got large scale, so they've got costs, right? So there was a need for them to sell Bitcoin. This might have been different in the beginning, where people were just mining Bitcoin on their laptops and they had no problem just hoarding hundreds of Bitcoins, but over time it became more of an industrial scale thing, and there was a real need for people to sell their Bitcoin in order to keep up their costs. And this was a constant and ever-present creation of inflation in Bitcoin. So most people have the idea that Bitcoin isn't inflationary compared to, say, fiat currency, but technically it's not true. Bitcoin is in fact inflationary, and it's going to be that way for maybe the next 100 years, I think, until the last Bitcoin is mined or something like that. I'm not exactly sure the details, but the idea is that all the Bitcoin that comes into existence comes through mining. But the idea is that the reward rate for the Bitcoin is going to go down by half every single year. So it kind of is the amount of free-floating Bitcoin that's created is going to go down more and more and more. So there should be less and less on the floating exchange as time goes on, ultimately creating a supply shock. Now, let's just say if we had the same demand for Bitcoin on the exchange markets, like the spot exchanges like Binance, Bybit, whatever. And, the same demand on OTC markets as we had in 2012. Even if demand stayed completely the same, just the fact that the supply of newly created Bitcoins is going down, that in and of itself is enough to cause the Bitcoin price to go up. Now, of course, it'd still be inflation, but it's going down less and less every year. Now, unlike the example I gave, the reality is there's a lot more demand. The network effect is increasing. You've got more and more people getting to Bitcoin every year. The amount of wallet addresses are going in. We went from just retail buying to institutions buying, and now even governments buying. So demand has skyrocketed. But the thing that's really important is the fact that the amount of new Bitcoin going onto the open market is going down less and less. But the times where it goes down like the most is when these halving events happen. So the first halving event of significance was in 2013, and that's when again, correct me if I'm wrong on the specifics of this, but it went from 1 Bitcoin being mined every block to half a Bitcoin being mined every block. Then 2017, it would have gone to 0.25 every block, and etc., etc. And this creates a supply shock that creates a very replicable cycle within Bitcoin. That basically there's a bear and bull cycle that revolves around these halving events. Now, when there is a halving event, it's not certain that the price immediately goes up. As you can see, so I've written lines here that represent when the halving events took place, but the price doesn't actually go up at that time. So if I zoom in on 2013, I'll have to go to, I don't have to go to log scale. We actually did get a little bit of a run, but I went it down, but it didn't really go to that parabola stage. In fact, you know what? I think I made a mistake. I think the halving was actually 2012. Hang on, 2014. Hang on, I may have made a mistake here. So 2017, 16. Sorry, it was in fact 2012. I made a mistake, yeah. I'll move that to around March, April or something like that, right? So nothing really happened at the time of the halving, right? You can see, I have to move up the log scale. What was the exact price at the time of the halving? I mean, it was a couple of bucks, basically. And, we didn't really see parabola occur for almost a year later, where it went all the way up to $1,000, basically. And you can see that this event has a very similar, it works in very similar ways. And by the way, this was a bit too early. It happened around March or something like that. And the price did actually go up. The feelings of the less supply on the market definitely had an effect, and it did go up, but it wasn't until like later on the next year where things just went completely vertical. So you can see the price definitely went up, but it was still, well below all-time highs until later on next year. And as you can see, it wasn't until the year after the halving that Bitcoin went completely vertical. And we can see the same thing again happening for the one in 2020. The one in 2020, like the price did start going up, absolutely. And but we didn't really break all-time highs until well, actually earlier this. Wait, hang on. This is, I gotta get out of log scale. It's getting kind of confusing to look at. As you can see, like there's a bit of a lull period, until we get to like around next year, which is 2021, and like until around a year, like a year after the halving happens, like that's when massive parabola happens, right? So if you wanted to find like the best times to buy, you would want to know exactly when the halving is, and you want to plan a time for that, right? So what about if you wanted to sell? Well, as I said, most of the time, if you did want to time the top, which is something I don't recommend, but if you did want to do it theoretically, you would want to look at every time there was a top before, and the top happened in the 2013 bull run. It happened in November, December. It happened in November, December as well in 2017. And then we've got in 2021 again, November, really, I mean October, November. And the chances are that it's going to be, again, the same kind of thing happening is extremely likely. It might be different, but I think sometimes it's just better to go with the history, because that's what continues to repeat. And it's just simply based on the fact that there are these very predictable supply shortage cycles, right, based on these halvenings. Now, my personal recommendation is not actually to just sell during that period when we're at the top. Not generally. Like, I think as someone that's trying to be responsible, like in this YouTube channel, and I want the best for my audience, people who've put faith enough to watch me, I don't want to recommend that people join the speculation game and try and time the tops and bottoms every time, because more often than not, you will get wrecked doing this. The best thing to do is to hold your crypto, ideally sell half, keep half. Like that, you can't go wrong with a strategy like that. Like when you feel like crypto is getting too high, you can sell half, keep half, and then DCA in and DCA out. DCA means dollar cost average, and that means you decide, you know what, every month or every week or every day, I'm going to put money in, and DCAing out, dollar cost averaging out, means you're every day, every week, every month, you're going to pull money out. So maybe what you can decide is that you're going to say, hey, look, generally speaking, towards the end of the year, after a year after a halvening event has taken place, I'm going to pick a date that's towards the end of the year. Maybe it's going to be October to January, right? January. Okay. And I'm just going to, actually, you know what? That's not right. I'm just going to pick, yeah, here we go. Just from October to January, right? So you've got October, November, December, January. You've got 4 months to slowly pull out the money that you said you were gonna pull out. You might just DCA and say, you know what, I'm just gonna take out, like if I'm gonna pull out 50% of my money, I'm just gonna pull out, you know, like a couple percent a day, you know, until I've reached my target, and then after that, I'm just gonna hodl the rest of it, because ultimately, the most important thing, as I mentioned at the beginning, is you've got to be willing to play the long game, and you've got to avoid the desire to speculate. There's going to be a lot of temptations to do it, but I don't recommend that that's a good thing for a long-term strategy. However, if you did want to pull out some of your money, because I think it is smart to take profit off the table, especially during times of a just extended parabola where things are, you know, because obviously the price is going up because of a supply shortage, and maybe some narratives are going around in the media. But at the end of the day, when you see these big vertical lines that happen in just like in a 6-month period, those never last forever. Nothing just goes up forever. You might see big multi-X gains, but at the end of the day, what goes up must come down, you know. So don't be scared, you know, to pull out a little bit of cash. But ultimately, I think if you're really serious about Bitcoin and you believe what it's supposed to do and how it can enrich your life, help you debank, then it's not recommended that you just, you know, go all in and all out just because you think the price is going to go up or to go down. So yeah, that's really it for this video. Make sure to subscribe if you like this channel. I've got plenty of videos about how to debank, how to use peer-to-peer cryptocurrency trading. Yeah, make sure you use my referral links in the description down below if you're interested in buying and selling crypto without KYC. It's something that's very rare to come by these days. If you want to buy crypto, for the most part, you're going to end up on some centralized exchange that's going to require you to KYC yourself, ultimately de-anonymizing your cryptocurrency experience. So make sure to use a non-KYC'd, non-custodial cryptocurrency exchange. Non-custodial means that if that crypto exchange just suddenly goes belly up overnight, sinks to the bottom of the ocean, your funds aren't going to go down with it, because ultimately the crypto exchange doesn't own your funds. That's what a non-custodial exchange is. So the best exchanges that I could recommend for this kind of activity is local CoinSwap and HODL. You can use my referral links in the description down below. And if you're interested in buying Monero P2P, you can use my referral link for BitValve and BitPapa. I've got a referral link for those as well. So thanks a lot for watching, guys, and I'll see you next time.